Good day, friends. Welcome to the lecture series on Fundamental of Investment. In this subject of Fundamental of Investment, we are discussing about mutual fund in India. In my previous lecture on mutual fund, I talked about what is mutual fund, how we define the mutual fund, what are the benefits of investing through mutual funds, why mutual fund is important, what are the features of mutual funds, and how mutual fund industry in India has evolved over a period of time. In this lecture, I will be starting with the structure of mutual fund in India, how mutual fund industry works, which are the different agencies, which are the different organizations which are involved in the mutual fund industry. So very first aspect is fund sponsor. Fund sponsor are like the promoters of a company. There are some individuals or the business house or the house which conceives the idea of starting a business in case of a company and which do all initial homework for starting a company. Similarly, in the mutual fund industry also, there is some fund sponsor who wants to start a mutual funds and they are like the promoters of the company. The fund sponsor are like the promoters. So the sponsor is the main body that establishes the mutual fund. The sponsor can be compared to the promoter of a company. Like the way the promoter acts in the case of a formation of a company, similarly a sponsor acts in the formation of a mutual fund. So the responsibility of the sponsor includes appointing the trustee with the approval of the SEBI, that is Securities and Exchange Board of India, which is a regulator, and setting up an AMC under the Companies Act 1956 while getting the trust registered with the SEBI. Right? So it is the job of the sponsor to get the trust registered. As I said, the sponsor will form a trust. So fund sponsors, right, will form the trust. So for example, ICICI Bank and Prudential PLC are the sponsor of ICICI Mutual Fund. Birla Sun Life Mutual Fund and Aditya Birla Financial Services and the Sun Life India AMC Investment Corporation are the sponsors. So these are the various sponsors, right? So for Birla Sun Life Mutual Fund, Aditya Birla Financial Service and Sun Life India, these are the two are the sponsors. Then comes the trustees, right? So mutual fund needs to be constituted in the form of a trust because people gives the money to mutual fund house which is being managed by a trust. Trust because the people trust the trustees that they are investing their money on their behalf. So mutual fund needs to be constituted in the form of a trust and the instrument of the trust should be in the form of a deed registered under the provision of the Indian Registration Act 1908, right? So a trust has to be formed by the sponsor for starting the mutual fund. So there are trustees. Number 2 is the trust. Number 3 is the trustees. It is the responsibility of the trustees, which are the individuals, right, which acts in the trust. So it is the responsibility of the trustees to appoint the AMC. The main role of the trustee is to ensure that the interest of the unit holders is protected while making sure that the mutual fund complies with all the regulations of the SEBI. So what it means is that they appoint AMC. AMC means asset management company, which comes next, right? So it is the trustee's job to see to it that interest of the unit holders is protected and all the rules and regulations of the SEBI is being followed in the letter and spirit. Then AMC, asset management company. So asset management company is the investment manager of the trust, right? So trust hand over this responsibility to a asset management company. It takes care of the day-to-day operation of the mutual fund and management of the investors' money as well. So it is the asset management company which manages the fund of the investors. For example, HDFC AMC is the asset management company of HDFC Mutual Fund. I mean, HDFC Mutual Fund is very popular mutual fund house in India. So this mutual fund is managed by the HDFC AMC. So the HDFC AMC is the asset management company of HDFC Mutual Fund. Then comes custodian. See, all the financial assets, or for that matter, all the assets that is being bought by the mutual fund house or AMC, the custody of that asset, custody of that equity shares, custody of that debt funds, money market instruments is being kept by the custodians. So custodian has the custody of all the shares and various other securities bought by the AMC. The custodian is responsible for the safekeeping of all the securities. The custodian is liable for keeping the investment account of the mutual fund. And then comes the registrar and transfer agents, right? Each mutual fund house has a thousands and lakhs of accounts, folios. These folios are being managed by the registrar and transfer agents. So registrar and transfer agents, RTA, maintains and updates all the investors' record, that how many units has been purchased by each of the investors, right? What is the NAV value of the units? Whenever the person want to get the units redeemed partially or fully, it is a duty of the registrar and transfer agent to get it redeemed, and so on and so forth. So the main function of investor serving through its office and various other branches. So its function includes processing of investors' application. When I say processing of investor application, application means either the fresh investment which any investor wants to do in the unit, or the redemption of the units. So processing of the investors' application, purchase and redemption of transactions by investors in various schemes and plans, right? Because each mutual funds have many schemes, different schemes. If you talk of the HDFC mutual fund or SBI mutual funds, or for that matter any mutual fund, they have many schemes, right, under which they collect the money from the investors. So for example, Karvi Fintech Private Limited, KFPL, and MyCamps are two very popular RTAs in India. There are many others, but these are mainly two which manages most of the mutual fund houses, which manages the fund of the mutual houses, and they act as a registrar and transfer agents of these mutual fund houses, right? So this is the structure of the mutual fund industry in India. Now, after talking of the structure, let me talk of the different type of schemes that are being offered by the mutual fund houses. Friends, it is very important to understand the different type of schemes. Different investors class, depending on their objective, depending on their risk profile, depending on their age, depending on various aspects, various features, there are different schemes that are being offered by the mutual fund houses, right? So what are the different schemes, and on what basis we can distinguish it? Let me discuss that. So one basis of distinguishing the mutual fund scheme is on the basis of structure. When I talk of structure, broadly, there are three different classes: open-ended scheme, closed-ended scheme, and the interval schemes. So open-ended scheme means this scheme allows the investor to buy and sell units at any point of time. This does not have a fixed maturity date, right? So you start a scheme, that scheme will continue for a long period of time, right? The time period is not defined. It may be 10 years, 15 years, 20 years, 30 years. It may be perpetual also, right? So this open-ended schemes keeps on running, and people do keep on investing money in that. People keep on redeeming the money from that, right? Depending on the net asset value. I will be talking net asset value later on. Means depending on the price of that asset which they have invested, right? So different people will keep on redeeming depending on their requirement. So open-ended scheme is a continuous scheme which continues, right? Then comes the closed-ended scheme. Unlike the open-ended scheme, closed-ended scheme is for a fixed maturity period, like for 15 years, 20 years, 10 years. So these are the schemes that have a fixed maturity. The money of the investor is locked in for that period of time. So, right. So if it is a 10-year scheme or 5-year scheme, so your money is being locked in for 5 years, and that 5 years, at the end of the 5 year, whatever the value of the investment will be, that will be shared by all the investors. Then comes the interval scheme, which is a mixture of the open end and the closed end, right? So these combines the feature of open-ended and closed-ended schemes. They may be traded on the stock exchanges, means daily basis you can buy and sell the security units, or maybe open or sale for sale or redemption during the predetermined intervals at a NAV related prices. NAV is the price per unit, the value of the per unit where the mutual fund, in whichever schemes you have invested. The other way of classifying the different schemes is on the basis of investors' objective, right? So one is called equity or growth schemes. Growth schemes means where the objective of the investor is that her money should grow, right? Over a period of time, he doesn't want a regular income. That investor, suppose you are a young person, you are having good job, having good salary. You don't want that you should get a regular income out of your investment. What you want is that you invest a X sum of money. This X sum of money should grow on a continuous basis, and after a period of time, you get good handsome money back, right? So you want your money should grow over a period of time. So growth schemes aims to provide capital appreciation over a medium long term, that you invest for 5 years, 10 years, 15 years, right? So over a long period of time, the investor invests the money. These schemes normally invest a majority of their funds in the equities and are willing to bear short-term decline in the value for possible future appreciation. Because, see, equities are an asset class which are of high risk, high return, right? The risk is high, but so is the return. When the return is high, so the equity as an asset class can give you a higher growth potential as compared to the debt or as compared to the other asset class, right? So normally these growth schemes, the mutual fund house invest in equity shares. So those investors who want that in the long term, their investment should grow at a high rate, so right? So these type of investor invest in growth schemes. The other is income scheme, right? So these schemes provide a regular and steady income to investors. These schemes generally invest in fixed income securities such as bonds and corporate debentures. Suppose you are somebody is a retiree, right? And a retiree person doesn't want to take higher risk, and the waiting period for the retiree is not very long, right? So the retiree person want to invest for 10 years, 15 years, 5 years, 2 years, right? What he wants is that whatever the investment that retiree person is doing, that should give him or her a regular flow of income. So this regular flow of income he will be getting if the mutual fund invest in the fixed income securities. They invest in bank deposits, they invest in say public sector bonds, they invest in corporate bonds, they invest in money market instruments, which gives them a regular income. And with this regular income, a income is being generated for the unit holders. So this is called income scheme. The first one was the growth scheme, other is income scheme. Third is hybrid funds. Hybrid fund is a mixture of the equity and the debt, right? Or it is a mixture of different asset, I can say. So a hybrid fund is an investment fund that is characterized by diversification among two or more asset classes, right? So these funds typically invest in mix of stocks and the bonds. Suppose I, in the age group of 50s and plus, want to invest, I am ready to take some risk, but I am not ready to take very high degree of risk. I want that there should be a reasonable degree of risk. So for a person like me, who is not ready to take very high degree of risk, it is better to invest in the hybrid funds. Because in the hybrid funds, there will be investment of some proportion in the equity shares and some proportion in the bond. Investment in the bonds by the mutual fund will give you a steady return, and the degree of risk in the investment in the highly rated bonds is less as compared to the investment in the equity shares. So depending on the market conditions, suppose the market is booming and the mutual fund manager feels that market has grown like anything, it has expanded very fast, right? Expanded means it has increased very fast. So the risk return is not favorable. So at that point of time, the mutual fund manager will increase its exposure in the bonds so that the risk is being mitigated and reduce the exposure in equity. If the market is low means if the Sensex and the Nifty is low, the prices are low. So at that point of time, mutual fund manager feels that the risk return is favorable in the sense that it is better to invest in equity shares at that point of time. So it will increase its exposure. The mutual fund manager will increase its scheme exposure in the equity shares, right? So in this way, they keep on churning their portfolio, and the portfolio consists of both equity shares and bond. So this is called hybrid funds. The other is called solution-oriented funds. Solution-oriented funds are being created for a specific purpose. I mean, you are a young person, you are recently married, you want that by the time your children grown up, right, and you need more money for their education. For that period of time, you want some money, fixed money should get in back, or you are making your retirement planning. So when you reach 60, you must have a lump sum money, or you must have a regular flow of income after retirement. You keep on investing in your life, and you want that after retirement, you should get a regular flow of income. So for this specific objective in mind, mutual fund managers invest the funds of the unit holders. So solution-oriented funds are the mutual funds which design their portfolio to achieve a specific goal like retirement planning and children education planning. Like it is a newly introduced category, means as compared to the pure equity or the pure debt fund is comparative. I will not say it's a newly, but comparatively it is a new type of schemes that are being introduced by the mutual fund houses. The other way of classification of the mutual fund is like equity or growth funds. See, I was referring to equity schemes, debt schemes, right? When I was talking of the growth schemes, I said those investors who want growth, who want their investment should grow, they normally prefer to invest in equity, right? So within the equity also, there are different types of schemes, there are different types of funds. Normally, if you have heard in the stock market parlance, the equity shares are being categorized in three categories depending on the market capitalization of the share: large cap funds, mid cap funds, and small cap funds. Large cap funds are by and large those companies which have large market capitalization. When I use the word market capitalization, means number of shares floated in the market, which are in float, which are there in the circulation, multiplied by the stock prices, right? That is called market capitalization. So if I talk of the BSE, right, in the Bombay Stock Exchange or the BSE, top 100 companies in terms of market capitalization, right? So which are the companies which are the top 100 companies in terms of market capitalization? You identify that. That constitutes large cap. Then comes the so large cap funds are those funds where the mutual fund managers invest only in these top 100 companies. Within that 100 companies, he will select, but he will be investing. The mandate of the mutual fund manager is, if the mutual fund house has created large cap fund, the mandate of the fund is that the fund manager will invest only in large cap, right? So large cap mutual funds are those that invest at least 80% of the corpus in top 100 companies by the market capitalization. Then comes the mid cap. Mid cap mutual funds are between the large cap and the small cap, that invest in the mid-sized companies, right? So which are smaller than the large cap and larger than the small cap, which are smaller than the large cap and larger than the small cap. And third is small cap funds. Small cap equity funds invest in the smallest companies in India. These companies are beyond the top 250 companies and are mostly unheard in our daily life. When I use the word unheard, I don't mean exactly unheard. Unheard means which are not very popular. Which are not very popularly. These names are not being popularly named. Like if I talk of the large cap funds, like companies like HDFC Bank, HDFC, Reliance Industries, ITC, Tisco, and so on and so forth. These are called TCS, Tata Consultancy, Infosys, Wipro. These are all called large cap funds, right? if I talk of the mid cap, like Godrej Properties, which are smaller than the large cap. Small caps means there are many names, there are a very large number of companies which are there in the small cap, right? So these are the three different type of equity schemes itself, equity or growth funds. Then comes multi-cap. These are the three classes. There is another class called multi-cap. Multi-cap is where the mutual fund manager has the mandate to invest in any of the capitalization company, depending on the stage of the market, depending on the market conditions, and wherever he feels that extra appreciation can be created. So whether it is a small cap, whether it is a mid cap, whether it is a large cap. Supposing there is a scheme called large cap equity scheme. So mutual fund house will invest only in large cap. If it's a mid cap, only in mid cap. Small cap, only in small. But multi-cap company, multi-cap scheme, I would say, the mutual fund manager has a liberty to invest in any of the share, whether it is a mid cap, small cap or large cap, right? So these funds invest in stocks across market capitalization, that is their portfolio comprises of large cap, mid cap and small cap stocks. Then comes sectoral funds. See, there are sectoral funds which invest in a specific sector of the market, like information technology funds, right? Like steel industry, banking funds, where the investor, where the mutual fund will invest only in a particular sector. Investor feel that when the COVID came to the world, the pharma companies were growing at a very fast rate, right? The demand of the pharma companies means the share price of the pharma companies was rising at a fast rate. So many of the mutual fund houses created pharma fund, where the fund house will invest only in the pharma companies, right? Or pharma companies, or I can say pharma and hospitals like Apollo Hospital, Fortis and all these, and different pharma companies they invest. Dr. Reddy, Divi's Lab and all these good companies they invest, right? So sectoral funds are those funds which are being created for investment in a particular sector. Like if I say IT sector, IT funds. So information technology funds, the mutual fund manager will invest only in the IT related company, right? So sectoral funds have the objective to invest only in the equity of those companies existing in a specific sector as laid down in the fund offer document, right? Then comes index funds. Index fund, as you know, we have discussed in the past also in many of our lectures. Like there are two indexes, popular indexes in India, and today also I refer this at some point of time in my discussion. One is the Bombay Stock Exchange, which is known as Sensex. The index of the BSE is called Sensex, and the other is the Sensex of National Stock Exchange, the two leading exchanges of the country, Bombay BSE and the NSE, right? So the Sensex of the index of the National Stock Exchange is known as Nifty, right? So these mutual fund or these schemes, I would say rather, invest only in the index schemes. So index funds means this is a fund where the fund house invests only in the companies which are there in the index. It may be, if it is a BSE Sensex index, so in the BSE Sensex companies. If it is a NSE Nifty companies, only in the NSE Nifty companies, right? So only those companies which are there in the index, either BSE or the NSE, depending on whether you are creating BSE Sensex fund or the NSE Nifty 50 fund, right? So only in the index companies the mutual fund house will be investing. So index fund try to mirror the performance of a particular index, such as the BSE Sensex or the NSE Nifty 50. Index fund will invest only those scripts mean shares that constitute a particular index. There is another scheme called tax saving, or we popularly known as ELSS, equity linked saving schemes. Many of the people in India invest for tax purposes. As you are aware that under 80C of the income tax in India, right, there are certain types of investment that if you invest in those investments, then there will be a deduction under section 80C. So in mutual fund also, if you invest in the equity linked saving schemes, it is covered under section 80C, means that investment is covered under section 80C. So tax saving schemes are mutual fund schemes that qualify for tax deduction under section 80C of the Income Tax Act, right? So they have a mandatory lock-in period of 3 years. So these saving schemes have a lock-in period of 3 years, but they qualify for tax reduction, means tax under 80C, right? Now the question, we have talked about different types of equity fund schemes, whether it was large cap fund, small cap fund, right, mid cap fund, index fund, sectoral funds, right, tax saving schemes. These are all different type of equity schemes. The question comes, why people invest in the equity funds, right? Broadly, I can say equity funds, debt funds, right? So why you invest in the equity? What are the benefits of investing in the equity funds? Or who should invest in the equity funds? My answer will be that equity funds are suitable for those following type of investors. Investors with high risk appetite. Friends, as I was saying in the course of my discussion in this lecture, that equity is subject to high degree of risk. The stock market keeps on fluctuating. Every day you will find Sensex move every minute. The Nifty moves every minute, right? So anything happens in the world, not only in India but happens in the world, right, that affects the stock market. If there is some geopolitical risk, if there is some economic risk, there is some financial risk, business risk, there are n number of factors which affect the stock market, which affects the prices of these stocks, shares, right? So those investors who are ready to take high degree of risk, they should invest in the equity funds, because although the risk is high, so is the return. But what is your risk appetite? A person in the age group of 75, 80, he has or she has very limited income. With this income, that person has to spend throughout his life, right? With this limited resources, by the interest income or whatever the income that is being generated by that, the savings, small saving which she has at her disposal, from that saving only she has to spend her life. So if that person invests in equity, and if equity falls for 2-3 years consecutively, it will be very difficult for that person, right? So only that person should invest who has a high risk appetite, who is ready to take high risk for a higher return. The other class is for long-term goals. That equity, it has been observed that over a period of time, equity has given better return than any other asset class. But when I am saying it has given better returns than any other asset class, I mean in the long term, right? So supposing I will be needing money for next year, right? So this part of money, that money, I should not invest in equity, because equity market keeps on fluctuating for 1 year, 2 year, 3 year, 4 years. Equity market may not perform well, so my investment will decline, right? The value of my investment will decline. So I should invest only that money in the equity market which I am ready to invest for a long term. So equity funds are for long term goals. So investors seeking high capital appreciation, I will not say capital appreciation, but high capital appreciation. So as I was saying, high risk, high return. Equity funds are high risk, high return. So high risk, high return means it will give you a good capital appreciation. So budding investor means new generation investors. As I was saying, that in the last 2-3 years, a very large number of investors have invested in the equity, and most of them are below the age group of 30 years. So budding investors who are young people who have started invested, they should invest in equity, because they have a long life, right, and they have a better risk bearing capacity. And last but not least, market savvy investors. So those who enjoys market, those who enjoys the fluctuations of the markets, ups and downs of the market, that class of people should invest in the equity funds. So friends, I think this is over for today, right? So in this lecture, we have talked about the different type of schemes. I will continue with these schemes in my next lecture. Thank you very much.